So hi friends, this is lesson number 8 and we are going to discuss about business accounting. Very important because this is more like a health report of your business and how to structure it and organize it. That is something a key, because tomorrow anything which is going to be displayed as a proof of your this all great business, it is going to be evaluated or to be seen through your books of account. This is very important and very precisely to be worked upon. So when we are planning about business accounts, 4 important things are here. One, the capital and assets, because the kind of money which you are investing in the company, the kind of assets which you are required to start your company, or maybe later on you are going to add into the company. Profits and loss, very important. What is your gross profitability, net profitability? It is going to show that either you can really survive and at what stage, how business can really take it to the next level. Cash flow, very important stage, because you have to really survive and sustain, and the cash is the most important factor. If you have enough money in your bank, then you can survive. Even if you have a great profitability, but if your cash flow is not good, somewhere you will struggle. And the projection plan. Why projection plan? Because we want to prove to the world that whatever so far we have done, basis on that trend and basis on the opportunities which we have on the table, if we work together, if we really play our cards well, we can really make this company multifold beneficiary company. So let's see one by one on each topic. So in the capital investments, 2 important factors we have. One is the assets and another is the deposits. Now when you are working on your assets, you have to question a few things before you are investing on it. That what kind of advantage you are going to get out of the investments which you are doing on machineries or any kind of assets. As an entrepreneur, as a startup, you need to really make a light asset business company. You have to question yourself that this investment is really going to give you immediate returns. So you have to check the advantage of these assets with your company. What is the tenure of period you are going to utilize and take the benefit of this all assets? Either it is really essential and very important at this stage for you. Second important is the age of your asset. Question yourself that how long this asset is going to remain with you. What is that time period you have to recover that money from the business? Third, the right agreements. You have to ensure that whatever assets you are taking in the company, you have a proper documentation, proper invoices, proper agreements. So you can take the best advantage of your all assets in your depreciation benefits and in your valuation benefits. You have to also calculate that in your valuation, in your business, whatever kind of a spend you are giving to this all in assets, what is the contribution it is giving to your sales, to your revenue, to your profitability. If it is not required to really invest money at the early stage, it's always advisable, think about alternates. And once you are comfortable, then you can switch from your outsourced solution to an in-house solution or asset-based solution. Question yourself that either it is an expense or a cost. Your asset, if it is an expense, means it is going to give returns to you, and you should know that how much time you required to really cover that money back in company. If it is a cost, means it is burning money for you, it is not giving any benefit to your revenue. Please don't do that, because it is a waste of your money at this stage. Once you have the money, it is your choice. Second is your deposit. You must be giving deposit against the security for a rental deposits. So whatever deposits you are giving to someone, ensure that the terms are something where you are getting that recovery from your all security deposits. If the deposit is something which is recoverable, that is your asset, because that money is your money just parked with someone else for a security. So that is your assets. But signing an agreement with the depositor, need to be very precisely aware about what exactly the terms been given to him, interest given to him, what kind of a challenges or terms which you are agreeing on exit of this all deposits. Please ensure that it is not making any kind of a dent to your company. Next, very important is your accounting standards. Account is something which is more like a health report of your company. You have to really precisely structure your this all report so everyone or anyone can easily read it, and you should be able to really pick the right trends, right gaps into it. There are 3 important factors here. One is the revenue, expenses and cash flow. Your revenues are all your sales vertical. You should know that from where all your sales and from which verticals you are making kind of a revenue. Break down into pieces. You should know all the verticals in detail. And you should be able to track the trend of your every sales vertical. Either it is making a profit and what kind of a contribution they are giving to your profits. Product wise breakup and the trends on all your verticals and product. You should know that either every that product what you are planned has really given the right results to you. You should know the gross profitability of your vertical wise, product wise, and the kind of trend means either it is every month giving you the same, week wise, quarter wise, month wise. Have the trend report of your gross profitability. You should know the key important factor of your each and every this stage, that how this is going to really help you. Key contributor of your all revenue, how it is really making better solution for you, at what time, at what season it is really making impact on your business. If you know the key factors, you can create a right alarms. For an example, if it is a seasonal business, then you know that before season what all action need to be done. If you know that because of some festival reason, because of some timing, it is making some kind of a challenges, so you can make a right alarm on your revenue systems. So accordingly you can really manage your expenses also. Second is very important, your expenses. Now you know that you have a heads in your accounts. Try to keep a very standardized and common heads in your account books. Every time don't please change it. Every year if you are keeping manpower as a manpower cost, keep the same head. Salaries as a salaries head, please keep same heads. Professional cost as a professional cost, please keep a same head. This will help you to really see that how this whole heads are giving you a trend kind of a solution. So this will help you to really create a right trend analysis. Try to find the cost per sales of your each and every unit, because every your vertical you should know that what kind of a per unit sales you are contributing as an expense there. This will help you to understand either whatever product economics you structured, the right kind of a cost you are investing in that product. Your product economics which you have calculated, you know that per cost what you are spending, and the contributors which you have already calculated. If there is a trend which you know that something is plus minus happening, that is more like an alarm to you, because this will help you to really define and really stick to your right net profitability which you have defined and which you have planned and assumed for. Find the key contributors. Every month you should know that which are the key important 5 to 6 contributors of your expenses you have. What kind of contributors are really going beyond your alarms. If you know those factors, you can keep working on it, modifying your decisions and take the right alarms on it. Alarm systems is very important in each your accounting standards. Every that factors which you already assumed and budgeted, that will help you to really precisely make this business model risk free. And even something is going wrong, you can take the right decisions at the right time. So that will help you to really avoid a bigger losses. Next is the cash flow part. Every day you should have a right method and process to really check your debtor agings. Something which you have already planned and decided, if it is crossing that aging, please have a very close eye on it, because cash flow is the lifeline of your business. Creditor aging, let's not give a very high aging on the credits also. It's okay to really avoid something to be delayed, but it has to be logical. And if you are keeping that age high, it will accumulate and it will give a lot of challenges for your next cash flow challenge situation. Trend, you need to know that at what time, at what age the kind of money is coming to you. If the cycle is very clear to you, if you keeping that very close check and eye on it, you can easily manage that cash flow with you. Working capital, I will always suggest keep some kind of a working capital reserve in your company. So you know that if something goes wrong with your cash flow, if the collection is not happening because of XY reason, still you have a cushion with you as a working capital. At the same time, you need to always keep eye on a daily basis which are those key spoilers you have in your this whole company, in terms of your debtor aging, in terms of your creditor aging. So if you know your key spoilers, you can put right alarms and right focus on it. If you take the right decisions at the right time, you can avoid the big losses. So please work on your revenue streams, please work on your expenses, and please work on your cash flow. The three important thing is capture the information, check your trends, and have the right key alarms in each factor will help you to really avoid big losses. Next is your financial model. What three important things you need to have in your financial model? The first is your trends, second is the assumptions and the projections. The trend are something like a proof that this is really possible, and you are extending all your assumptions basis on that all factors. That is your run rate of that business. So So do a corrective steps. With my new method, with my new model, I can really change and find the solution on it. It is a good proof of concept to prove that you have an action plan, that if you change it, you can make a great benefit for yourself. You are identifying your opportunities basis on your performances, because you know that what all great things been done. Basis on that, you are finding a right business sources. You are putting across that basis on these opportunities, I have another great sources available for me, and I can make a list of my resources to prove that yes, this is my projection. So only your trends are the key important key factor here as a proof of concept. You have to prove with the facts, you have to prove with your pilots, but the numbers, the statistics, something booked in your accounts are the key factors. Market share, this is on the performance, whatever the potential size of market you have identified, you have gone to the right customers, what kind of a market share you captured, and now based on that market share, you are showing your potential market as an assumption, and based on that you are showing the execution plan that with all these milestones, how I can achieve a better market share in the market. And last, if something is still you are not done great, if you have growth barriers with you, but you know that what all actions been going to help you. So if you know your growth barriers and you are identifying all that analysis and sharing that as an assumption with the right case studies, you still have a proof, still have a chance to really ask for a support. Your accounts are something is going to show a trends. Your account is something as a proof of concept that this is practically done. And based on that trend, based on that run rate, you are producing that all logic, you are creating that all assumptions, and based on that assumptions, you are making a projection report, and that is proving that it is really possible. We cannot create anything basis on the hollow or shallow numbers or basis on the survey. If you are at the early stage, it is possible. But once you are already into the business, you have to prove with your books, and you have to justify with your current run rate that how you can really going to extend that with your assumptions, with your logics. Because these trends, these assumptions will help you to really decide at what stage, what kind of a funds are required, what kind of a budgets are required, how you can really find all the action plans to achieve your projections. So you will select the right methods, you will select the right investment, you will go to the right people and go to the right option to get your all these projections achieved. This is our 8th POC. We discussed about assets. We have understood the standards of our accounts, and we understood that financial model, why projections is very important, but how we can really take the journey from our existence, from our accounts to extend that to convert into projections. Friends, next lesson we are going to discuss about organization. See you in the next lesson.